So in contrast, smart levels are organic in nature. They're based on auctions where they happen instead of just in a particular time frame. They expand and contract based on real market activity, and they're not dependent on knowing a day type, and they're not based on arbitrary statistical measures. They're based on real auctions happening where they are. And I wanted to emphasize that there's no pattern recognition needed here. We're not looking for all those sort of crazy patterns that we've all heard of, head and shoulders, descending triangles, flags, pennants, wedges, or any of the sort of Japanese things, dojis, gravestone dojis. I know I spent way too much of my life trying to look for patterns and whatnot, and I always found it to be pretty elusive and really more of a historical analysis. It's easy to go back and look at charts and figure, hey, look, there's a head and shoulders or something. But when you're looking at the right side of the chart, it's very hard to figure these things out. And at the end of the day, I just don't think that they're statistically meaningful. There's something there, right? You see the market react off of them sometimes, but it's not enough to have a consistently profitable trading approach. Now, with the smart levels, there's no waiting for situations to show up. We don't have to wait around till we see a nice head and shoulders, right? The auction pattern is always there. As long as there's trading going on and our theory is correct, right, there should always be an auction there. And I think once you start looking for these auctions and putting smart levels on your charts, you're going to have this truth about this theory reinforced to you day after day, because every day you'll see this pattern of the auction going on and you'll be able to put your levels on it. And while there are some days where the market is rotating the whole day, and that does happen on some days, there are days where there's no auction just because we're getting a strong trending move, right? But that's pretty rare. Almost every day there is at least one auction that you can see, and then maybe the rest of the time is rotational trading, moving from one value area to the next. But more often than not, there's multiple auctions in any given day, and it's important that we identify so that we have the proper levels on our chart. And being able to see this day after day as you're working through putting levels on your chart, it really helps build some confidence that there's some real fundamental truth behind this approach. In fact, you'll start looking at charts and you'll wonder why you never were able to see this before. You'll never look at a bar chart the same way again. The other thing is the smart levels have an uncanny way of identifying the high or the low of the day. So a lot of times in the charts, and you can go look at my website, I have quite a few daily charts posted there on my website or my blog, and you can look at those charts to start flipping through them, and you'll see that quite often the smart level, prior to the day opening, it identifies the high or the low of the day, or both. So it's important to remember in all of this that we don't know which way the market's going to go. We don't have a crystal ball. So the way we're using the smart levels is to position ourselves at these opportune moments, these inflection points in the market, so that we can have a really small risk on our trade with an opportunity for a big win. That way we can lose more often than we win and still make a profit. How many of you can lose more often than you win, right? That's easy to do, right? So the key, though, is that when you're losing less than when you're winning. We want outsized profits, right? We want outsized winners so that they can make up for a string of losses. Losses are inevitable. We just want them to be small. And with proper positioning, we can have this very small risk on our trade, but we know because of understanding the auction that we're in a position for the market to make a big move our way, certainly when it's compared to our potential risk in the trade. So once you start creating smart levels on a particular market day in and day out, you get to know the market better. A lot of people told me when I first started trading, they said you should trade just a couple markets and get to know them really well. And I had no clue what they were talking about. I don't think they knew what they were talking about either, to be honest with you. But one of the things I discovered as I started putting these smart levels on day in and day out, I actually got to know the market. In other words, I didn't know it the way maybe people have meant it in the past, but all of a sudden I see the way the market's auctioning, and I know what the market has done in terms of the auctions. I know the levels that are going to be significant, and all of a sudden when I'm putting trades on, I've got a really good feel for what the market can and can't do. And I don't have a crystal ball, but I know that if I position myself here, I can have a really short stop loss, because if it actually hits that stop loss, I know that I was wrong, right? Because of my understanding of the market, I know that I was wrong, and I can know it really quickly. But at the same time, because I understand the market and how it's behaving, I know that I have a really good opportunity to get that outsized profit. And so it puts you in a much better psychological position, knowing that you've got small risk, and when you hit those big winners, it feels really good. And this concept of knowing the market, it pays huge dividends. Okay, floors of a building. So smart levels are kind of like the floors in the building. And I've found over time, especially working with traders on the option strategy, that using levels in your trading is just a lot easier way to trade for most people. With a level, you know when the market's getting close to the level. You can anticipate it. You can see the market sort of working towards a level, and then it hits the level, and then you can take action or not, and then the market progresses, and then maybe it's getting closer to another level. So you can kind of anticipate things, and it really helps. Whereas with a lot of indicator type approaches, all of a sudden just the indicator is using some fancy formula, and all of a sudden that calculation switches from, let's say, long to short or something like that, and it kind of surprises you, right? And then you're stressed to act quickly based on that change in indicator direction, and so it's a much more stressful way to trade. I think in general, using levels to trade can be a lot easier for most people to implement, because you can anticipate those reactions. So for this diagram, if your levels are statistically significant, as you enter a floor, let's say we're going up in this building here and we enter one of the floors, if the environment in that floor is acceptable, then there's a good chance you'll head up to the next floor. So we can kind of use smart levels as targets in that respect. So if we move past one smart level and the market finds the environment good up there, we have a really good chance that we're going to make it up to the next level. So we can use the smart levels as targets. Now if the market enters a floor and it doesn't like the environment, there's a good chance it'll move down to the floor below, or more often than not, it'll move at least back to the high volume level in the previous auction in the previous floor. So we have, even on our rejections, when the market moves through a level and then decides it doesn't like it, we have targets going back the other direction. So all of this kind of informs your trading and gives you parameters where you can really make good trading decisions. This whole thing with levels and floors of a building may not seem like a big deal, but I really believe that this concept and having this framework in your mind can really be the difference between profitable and not being profitable. Okay, the line in the sand. As a market approaches a smart level, traders and or the market react to it in a similar way that the cars we see in this diagram are reacting to that line at the stoplight. Some stop before the line, some stop right on the line, and some overshoot the line. However, this does not diminish the significance of the line, right? Everybody knows where that line is. The line has to be drawn somewhere. So the point here is that smart levels aren't precise measurements. However, you'll be surprised how many times the market goes right up to a smart level, and within a tick of the smart level, or right on the tick of the smart level, the market will react. But in general, they're basically lines that are honored, just like this line for the stoplight is being honored. But because the market's organic in nature, not everybody honors it the same way. Some people overshoot it. The market sometimes overshoots the smart level. Sometimes it hits it right on. Sometimes it's just a little short. So it's important to keep in mind that while the value for the smart level is precise, the way the market reacts to it isn't necessarily precise all the time. The markets are organic and they're driven by investor psychology. So the smart levels are just artifacts that are left from that psychology, and we need to keep this in mind, that it's much more of an organic, natural approach as opposed to a mechanical or formulaic approach. Okay, here's a chart for January 20th, 2010, and you just maybe want to take a look at this chart and see how many times the market reacts off of these levels on this chart. And there may be a tendency to think I cherry-picked this chart, but I have, at this point, maybe hundreds of charts with different markets on my website and blog that you can go look at, and you'll see that these kinds of things happen day in and day out, and you should take a look at those. In addition, later in the course, I'm going to cover a 2-week contiguous period of time, in other words 10 straight trading days in a row for 3 different markets, and show you how we identify the auctions, how we place the levels, and then how the market reacts off those levels the next day. So we're going to go through that 2-week period, and obviously because they're contiguous, there's no way to cherry pick there. So you'll see the same exact kinds of behaviors going on that we'll see in this example here. So let's real quickly tick through here and see how many times the market reacts off these levels. Here the market looks like it opened down with this Renko chart, probably just opened down here, went through 2 levels, went through this one, then went through this level, and then reacts off the smart levels here, 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 and here. These are all great trading opportunities. Reacts off here, reacts off there. If you're being charitable, you could call these reactions. They're probably not tradable. Same with this one. But then here, nice trading opportunity. Beautiful trading opportunity there. Right there. Again, right here. And right here is a good one. And then look at that. We ended the day right on a smart level. So on a single trading day, these levels were put on the chart prior to the trading day opening. So we can see that on a single trading day, we have lots of reactions off of these levels. So it should show you there's something statistically significant going on here. Let's take a closer look at some of the situations on this chart. So let's first talk about position trading. Later in the course, I'll go into multiple ways to deal with swing trading or position trading. However, for this example, let's just use the simplest approach and say that we're simply going to react if the market hits one of our smart levels. So here we have the market going down through one of the levels. As it goes through here, we'd initiate a position somewhere around this value here, and then what we'll use as our stop is the prior smart level. So we entered right about here, somewhere in this area, and then we have our stop up here. And then all this activity, even if it came back up here, we would still capture all this activity without getting stopped out, because we're not looking to trade these small swings. We're position trading. We're not day trading. And we could use a different time frame for this chart. I usually like a fairly low time frame, because it doesn't really matter what the time frame is, right? What matters is when the market hits one of our smart levels. And we could change this chart, the chart that created the smart levels. We could change the time frame of that chart, and it would probably get us fewer smart levels during any given day, and therefore we'd have less trade management to do, if you will. But even though we're using a different time frame to create the levels, we're still looking for the same kinds of auctions that show up in those time frames. So you can manage how frequently you trade based on what time frame you're doing your analysis in. So we can see that that was our initial trade. We opened it and had our initial stop loss. And so then we'll go to the next slide, and we can see we were looking at this area before, and we entered here, and then the market came down and hit this next level down here. So this time, our original stop was somewhere up here, so we're going to move that down here. Once we broke this point here, then we came down later, hit another smart level. So now this moves down our stop to down in this area. So let's go look at the next continuation of this trade. So we've come all the way down this chart so far. So we've come down here, right? And that was the last time we moved our stop to right there. Now we came up and hit our stop right there, right? So what we can do here is reverse our position. So if we reverse our position, we were able to capture all of this profit. Well, actually it was from here, so let's get rid of that. So basically from here we captured that profit all the way down to this stop loss here. Now that we're long from this position, our stop is down below this line right here. And as we head back up, as we cross this line right here, we're going to move our stop up to here. Okay, then the market's continuing to climb. We hit this, cross this smart level right there. We can move this stop up to here. Now we can go into the end of the day with our stop somewhere in this area right here. So we were able to capture some profit on the way down, and we've been able to lock in our profit by moving our stops up here. Now from day to day, as we go into the next trading day, our smart levels will change. They won't be the same levels as today. So the way we manage this stop going into the open tomorrow may change based on how our smart levels change as we do our analysis at the end of the day. However, the next day, suffice it to say, we are going to have a stop somewhere on the chart on some level and be able to manage the trade the same way we did on this day here. And again, if this kind of analysis is too frequent for your position trading, all you got to do is change the time frame in which you develop the smart levels. So let's look at day trading. The key with day trading off smart levels is basically knowing when to become engaged, right? We want to stay out of the random behavior and only become engaged when we're around one of our smart levels. So down in this area down here, there's really nothing informing our trade, right? Our smart levels up here. So these are the areas where we want to become engaged and be trading. I think that's really a key benefit of trading off the smart levels, is avoiding the randomness down here and only keying off of the day trading points around here. So if we can take a closer look at this particular day, the market came down through here. We could possibly be looking to trade a retracement because the market was basically what we would call initiative selling. There's no buying coming in after it crossed this level to head back in the other direction. We don't see that responsive buying. So what we can assume is that we're maybe possibly heading down to the next level below. And if you remember from looking at our position trading, that's exactly what happened. So this is a really good sign here that we tried to retrace, had some responsive selling come in. This would be a good time to sort of jump on the trend, if you will. But it didn't really go very far. Even though it did go down, it didn't go very far at all. We'd probably get stopped out at some point in this trade. However, as it comes back and gets to our level, right, this is where we want to become engaged, right? So what we're looking for is this responsive selling, and you can see it in here in this tail on the Renko bar. So this tail right here tells us that as the market came up here in the order flow, if we're watching order flow, we would see that responsive selling coming in, and we could jump on this trade and try to get a piece of this move down. Then the market came back up, was buying, 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 and then we don't care what's happening down here, but when it hits our line, we see this tail, or we see on probably some other tool that we're using, we see this order flow reversing from buying order flow into selling order flow right at our line. So we're going to jump on this trade and try to get a piece of that move. Again, the same thing here. Comes back up, right up to the line. We see the responsive selling coming in. And again here, it actually makes it through the line a little bit, but then the responsive selling comes back in. And then once again, it comes back in right here. So the market's really making a big effort to get through this line, but can't seem to do it. And each time we get this responsive selling that we'll see in the order flow that gives us an opportunity to take a piece of that move down. Now here's a situation where we have a nice move down, and then we have a retracement, and we see some responsive selling coming in. It's not near a line, but we wouldn't expect that in this situation. So this is what you would call a continuation trade. In other words, we're seeing the market bounce off of here. We're expecting the market to go down to the next smart level below, right? So what we can do is we can hop on these retracements as we see the responsive selling and the order flow coming in. We can hop on the retracement and maybe have some sort of stop loss strategy as we're going down, but each time it retraces, if we see responsive selling in, we can get back in because we know we're heading down. Our perspective has changed. So as it was hitting this level, we're saying, we're going to be doing counter trend trading. We're seeing this responsive selling coming in right at our level. So that's a counter trend, right? The trend was, in this case, going up. We're taking a counter trend trade, trying to get a piece of that. But then after a while, if the market gets down to a certain point and we see these retracements, we watch the order flow, see some responsive selling come in, we can hop on these retracements and do a trend continuation type trade. And on the way down to the next level, we might have multiple retracements where we can hop on and get some profits that way as well. So depending on your trading style or whatnot, you might only want to trade retracements on a trend. The smart levels can inform you where we're trending to and from. So here we know we're trending down to the next smart level, so I'm going to hop on every retracement as we're heading down there. Or you could just focus on the responsive selling right at the smart levels. These are going to be shorter trades, smaller profits, smaller potential profits, but it's probably a higher percentage trade. The trend continuation, obviously, probably a lower percentage trade, but potential profits are bigger. So just to reiterate, by only becoming engaged at these inflection points, at these critical junctures in the market, we filtered out a lot of the random trading that we might otherwise normally be involved in. Okay, so I mentioned order flow in the previous slide in terms of trying to identify that turn in the market. Order flow is a great way to try and identify those turning points in the market. Now, the reason we want to focus on order flow, the premise behind it is that volume will oftentimes lead price. In other words, we'll see changes in volume before we'll see changes in price. So it gives you a heads up that a turn in the market is coming. So one of the ways, and the most rudimentary way to watch order flow, is to watch the DOM, or the depth of market, which almost every trading platform I've seen has some version of it. And the way it's made up is you've got this display of selling limit orders, and this guy, people who have limit orders at this price basically are saying, hey, I'll sell this market, but I'll only sell it at 776.50, right? So, and these people saying something similar as well. And so the actual market's right here right now. So it may take a while before this guy gets filled on his limit order. Same way down here, these guys are saying, hey, I'm willing to buy this market, but only if it gets to my price. In this case, this guy's down here, 775.60. So if you spend lots and lots of time watching this, you can start to pick up on these changes in order flow. So essentially, as the market's working its way up, let's assume the market was kind of working its way up, this DOM here, this yellow area, if you will, started working its way up, and then all of a sudden, let's say our smart levels like right here, we can see what that behavior was coming up to this level, and then all of a sudden we can see the change in the order flow right here, and then the price starts working its way back down. So if you get good at it, you can start seeing the order flow right here. Now, this is probably pretty tedious for most people and not something that I know most of you will probably get into, but it's the most rudimentary way to identify order flow. There are a number of tools out there. There's a charting package called Market Delta that's very volume oriented. That can be a really helpful tool. There are also lots of volume-based indicators that can help us identify these turning points. Now, I said volume leads price, but I believe it only leads price at certain points, at those turning points. You can't necessarily say, okay, I'm only going to make all my trading decisions based off of volume. In other words, as it makes that turning point, and then you're basically saying, well, I'll hold this trade until volume turns around or something. It doesn't really work that well. It's kind of momentary. So really what you want to focus on are those turning points, and that dovetails perfectly with our smart levels approach, because we've got these points at which we know the market is going to react, and we're waiting for that turn in order flow at only these situations that we're focused on, and that's where you can use order flow to give you a heads up to initiate your trade with a very tight stop. So as I identify the volume-based indicators that work well, I'm going to be creating videos that I add to the course over time, and I'll be demonstrating different kinds of tools that you can use to help you monitor order flow and harness the power of using order flow in conjunction with the smart levels. Okay, so what's coming up next in the course? We're going to identify how to see these auctions on real charts. We want to be able to identify the auctions easily in our analysis. We're going to find out where to draw the levels once we've identified the auctions. We're going to use examples using real charts and we'll go through a number of real situations on how to identify auctions and draw those levels. And we're also going to go through a 2-week case study using the Russell 2000 E-mini, the S&P 500 E-mini, and the crude oil contract. So it's going to be a case study over 10 trading days on 3 different markets. So that'll be a real good exercise to help you understand exactly how to identify the auctions over the period of days in some real trading. So in that case study, what we're going to do is we're going to not only show how you identify the auctions and place the levels, but then we'll also look and see how the market reacted to those levels in the next trading day. And we'll do that over a period, day after day for 10 days, and it should give you a really good feel for how you can use this in your trading on an ongoing basis. We're also going to look at position trading and day trading, and we're going to take a closer look at the market movements around the smart levels and how we might be able to leverage that in our decision making. Also, we're going to look at some indicators and tools to help trade using the smart levels. And like I said, over time I will continue to add videos as I find new tools that are useful to help us manage order flow and trading around the smart levels. The possibilities for using smart levels are endless, and I hope to add to the content in the course over time as we explore and find new tools and new ways to use the smart levels. Okay, in the next section of the Smart Levels course, I'm going to cover how to create the smart levels. Thanks for listening, and let me know if you have any questions.